Hi everyone, welcome back to my channel. Today we are looking at HIMS and HERS Health following their Q4 2025 earnings release on February 23, 2026. While the market reacted with intense volatility, our analysis suggests a significant valuation disconnect. We've reconstructed the valuation model that isolates the core legacy business from the high growth but legally precarious GLP-1 weight loss segment to determine if our original 17.00 entry price still holds weight. Looking at the raw numbers, the fiscal year 2025 ended on a high note with total revenue reaching $617.8 million for the quarter, a 28% increase year over year. While this slightly missed consensus due to specific shipping cadences we will discuss shortly, the full year revenue surged 59% to $2.35 billion. Most notably, adjusted EBITDA beat estimates at $66.3 million, even as gross margins contracted to 72%. This highlights a business that is scaling rapidly, even as it navigates a shifting product mix. The central tension in the HIMS story right now is the GLP-1 vertical. We are facing elevated FDA scrutiny and a tough regulatory landscape that includes a Novo Nordisk patent lawsuit and an SEC investigation into GLP-1 disclosures. To mitigate this, management has executed a strategic pivot by acquiring Eucalyptus, Australia's premier digital health platform. This $1.15 billion deal provides a critical hedge, diversifying the company geographically and therapeutically away from US compounding risks. To find the true floor of this stock, we stripped away every dollar of revenue and cost associated with weight loss. Using a conservative 10.5% weighted average cost of capital and a 12 times EBITDA terminal multiple, which is quite modest for a health tech peer, the model yields an intrinsic value of $35.84 per share. This confirms that the core business alone, entirely independent of the GLP-1 engine, is worth more than double our original buy price. Right now, the market is fundamentally mispricing HIMS. At a current market price of roughly $15, investors are essentially assigning a negative value to the weight loss segment. They are pricing in not just a loss of revenue, but a total business collapse. The reality is that by buying at these levels, you are acquiring a legacy platform generating $1.8 billion in revenue at a huge discount, while getting the Eucalyptus acquisition and GLP-1 optionality effectively for free. The miss in Q4 revenue was less about demand and more about accounting cadences. While revenue of $617.8 million was just shy of estimates, the subscriber base grew 13% to over 2.5 million users. This operational excellence was overshadowed by a transition in how the company fulfills orders, specifically moving toward personalized 503A fulfillment for sterile weight loss products to ensure long-term regulatory compliance. We saw a 490 basis point contraction in gross margins, but this was a deliberate evolution, not a failure of efficiency. Three factors drove this: the product mix shift toward higher-cost GLP-1 injectables, a massive 825% surge in international revenue, where HIMS is currently prioritizing market share over profit, and the expansion of their facility footprint to over 1 million square feet. As these operations scale, we expect significant fixed cost leverage to return. One of the most bullish signals in the Q4 report was marketing spend improving to 39% of revenue, a 7-point improvement year over year. This suggests that HIMS and HERS has achieved household name status. The brand is now benefiting from organic and direct-to-consumer engagement that reduces acquisition costs, allowing the core business to grow sustainably with significantly less incremental dollar spend. We must be clear-eyed about the legal and regulatory scenario. In February 2026, Novo Nordisk filed a patent infringement lawsuit targeting HIMS delivery technologies, and the FDA referred the company to the DOJ regarding the marketing of unapproved drugs. Additionally, the SEC is investigating disclosures related to the GLP-1 business. While these represent significant tail risks, our valuation model accounts for the total cessation of this vertical to ensure our floor is solid. The $115 billion Eucalyptus acquisition is the strategic answer to these US risks. Eucalyptus brings a $450 million annual revenue run rate and over 775,000 customers across Australia, the UK, Germany, and Japan. This move reduces dependence on the US compounding loophole and provides a roadmap for global clinical infrastructure, potentially allowing a pivot to name brand GLP-1 distribution if needed. Management was very smart with the deal structure to preserve balance sheet flexibility. Only $240 million is payable as upfront cash. The remaining $910 million in deferred payments and earnouts can be settled in either cash or stock at the company's option. This provides a vital liquidity buffer if domestic cash flows are temporarily impacted by FDA or DOJ actions. Our core-only model is built on three major shifts identified in the Q4 documents. First, we increased modeled capital expenditure to 1.5 to 2.0% of revenue to support the new vertically integrated pharmacy footprint. Second, we accounted for the structural improvement in marketing efficiency. Finally, we established a 2025 core revenue baseline of $1.8 billion, confirming that the vast majority of current profit is actually driven by non-GLP-1 offerings. To ensure this isn't a best-case model, we used conservative inputs. We applied a 10.5% WACC to account for a high beta and the telehealth risk premium. We also aggressively tapered revenue growth from 20% in 2026 down to just 10% by 2030. This ensures our valuation doesn't rely on infinite hypergrowth assumptions, but rather on the steady, asset-light efficiency of the legacy specialties like hair, skin, and sexual health. Here you can see the 5-year projection for the core business. Even with the GLP-1 vertical completely removed, the company is projected to generate substantial unlevered free cash flow, growing from $324 million in 2026 to over $600 million by 2030. This is a high-margin, cash-generative machine that the market is currently ignoring in favor of regulatory headlines. The final math brings us to an enterprise value of $8.314 billion. After adding back $929 million in cash and subtracting $1 billion in convertible notes, we arrive at a total equity value of $8,243 billion. Divided by 230 million shares, we get our intrinsic value of $35.84 per share. Again, this floor is more than double the current trading price, suggesting the stock is severely oversold. In conclusion, the sum of the parts is undeniably greater than the current whole. The $65 million revenue headwind and the SEC probe are temporary obstacles that have created a low entry point. The fundamental story that supports the core business valuation is still intact. We believe the technical bottom was likely in at the $40 mark, and the high-volume recovery on March 2nd supports this. We are maintaining our buy recommendation with a price target of $35. A revaluation is required if there is any significant event occurs, including but not limited to litigation development, regulatory updates, major business changes, etc. Disclaimer: I long HIMS. This is not investment advice. This is for educational only. Do your own due diligence.